How the Federal Reserve destroys younger generations. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over how the Fed crushes job opportunities in the real economy. It starts with the Fed creating this boom-bust cycle over time with 0% interest rates, quantitative easing, all this funny money. They completely remove price discovery from the market, not just the real economy, but the financial economy as well. This creates massive distortions over time because scarce resources with alternate uses get misallocated everywhere across the economy. And the Fed just kicks the can down the road. They delay taking the medicine they need to clean out the system. It's like this spring-loaded doom vortex. The longer they kick the can down the road and financialize the economy with 0% interest rates and quantitative easing, when we finally do get to a recession, it creates a doom vortex that's 10 times worse. The stock market crashes, which makes the corporate bond market crash, which implodes the pension funds, which reduces the tax base, so all the boomers have to take their money out of the stock market, which makes it go down even further. And this chart of the PMI illustrates it perfectly. What is the PMI, you may be asking yourself? Well, let's go right to Investopedia and check it out. The PMI is the Purchasing Managers Index. The Purchasing Managers Index is an index of the prevailing direction of the economic trends in the manufacturing and service sectors. It consists of a diffusion index that summarizes whether market conditions, as viewed by purchasing managers, are expanding, staying the same, or contracting. The purpose of the PMI is to provide information about current and future business conditions to company decision makers, analysts, and investors. I want to point out something very important about the PMI that confuses a lot of people. It's a number that's just based on the attitude of this month compared to the last month. So if you see the PMI go down by a lot and then the next month go back up, it doesn't necessarily mean that conditions improved a lot. It's just that 50 is the baseline number. So let's just say that the PMI goes down dramatically and then the very next month goes back up to 50. It doesn't mean that conditions improved. They just stayed the same as they were last month. So let's look at a chart of the current PMI in the United States. It starts at 2012, goes all the way to where we are today. The bottom number is 25, the top number is 55. Again, the baseline number is 50. So if we get a reading of 50, it means nothing has really changed since the month prior. A reading over 50 means that the managers are more optimistic than they were the month before. A reading under 50 means they're more pessimistic. So starting in 2012 goes up nicely. It really stays up. It's doing well until we get to 2015. Then in 2015 it comes down, but that doesn't necessarily mean that the economy is contracting. Goes up nicely until we get to the cerveza sickness. Then it drops off a cliff. It goes all the way down to 25, an unprecedented number. And keep in mind, even if the PMI next month bounces back up to 50, it just means that things are still as bad as they were the month before. And this perfectly illustrates the spring-loaded doom vortex the Fed has created with their boom-bust cycle policies. Oh, but wait, there is more. The Fed also creates an environment that incentivizes the CEOs and these big corporations to only think short-term and not to invest in the future, which of course destroys job opportunities for younger generations. And we can see this directly in buybacks. Editor, go ahead and throw up the chart of buybacks going back to 2010 we always talk about. The majority of the increase in the stock market is a result of corporations just buying their shares back. It isn't a result of the economy improving fundamentally. And I'm by no means the only person pointing this out. Let's go to a recent interview on CNBC with Chamath Palihapitiya, and I'm sure I'm pronouncing the name wrong. I apologize, Chamath.
The 500 companies in the S&P 500, so these are the 500 best companies in the world, they bought back $7 trillion of stock and or issued dividends, okay? That turned out to be more than 90 cents of every single dollar of profit that they made over the last 11 plus years. The federal government, as well as the Fed, between monetary and fiscal stimulus combined, have essentially transferred around $7 trillion now back to those said companies, as well as, companies slightly smaller than them. And I think why I was frustrated is that I just think that kind of behavior makes no sense. And instead of being punished, it has been rewarded.
Instead of these actions being punished like they would in a free market capitalist society, they're being rewarded. I couldn't agree anymore. But Jeff Snyder takes it a step further in a recent blog post and really articulates well why the Fed has created this type of economy that's built on a foundation of sand. Here, Jeff describes how corporate America was so structurally unsound even prior to the cerveza sickness. If businesses were already pushed toward the brink, they aren't going to be able to withstand these further massive pressures. Talking about the cerveza sickness. They had no room for error, no cash, or not enough of a profit cushion from what many had merely presumed had been an economic boom to leave them with a few months of spare capacity. But you can't absorb even a couple of months of huge cash losses paying all or most of your workers if you're already in the hole. Instead, without any space on either the top or the bottom line, it's right to the unemployment line for far more employees than might have been the softer case had the economy actually been in good shape heading into the shutdown. So why didn't the corporations have a rainy day fund? Why didn't they have any savings? Why did they take 9 out of every $10 they made and put it right back into the stock market to buy their own shares back? Because it goes back to the Fed. When they drop interest rates artificially low to quantitative easing, they're telling the corporate CEOs, hey, we've got your back. We're putting in a Fed put. We're going to print up as much funny money as we need to prop up the market. So go ahead and buy your shares back and you'll get rich risk-free. So if you're a fat cat CEO on Wall Street, all you have to do is buy your own shares back and the Fed is going to make you rich while they destroy the economy and all the job opportunities for the younger generations. Step number 2, the Fed's policies increase asset prices and risk. Let's go right to the charts. One of my favorite, home prices adjusted for inflation going back to 1900. The average trend line right about 100. It stays very consistent up and down slightly until we get to 2000, 2002. Insert this guy right here with a beard and glasses saying, "We live in strange times." Who do you think that is? Of course, none other than Krugman, who's on every single ad before one of my videos. But he came in and actually argued that we should inflate a housing bubble to make up for the dot-com bubble. I'm not making this up. Let's go right to an article from Mises.org. And this is from a 2002 New York Times editorial from Krugman. Quote, to fight this recession, the Fed needs soaring household spending to offset the moribund, whatever stupid economic word that is, who knows what that means, moribund business investment. In other words, in normal people speak, to offset lower business investment. So, Alan Greenspan needs to create a housing bubble to replace the NASDAQ bubble, straight from Krugman himself. And if you're not already going to Mises.org, definitely check it out. It's an awesome website, Austrian economics. It's a place where guys like Lou Rockwell, Tom Woods, and Bob Murphy put the smackdown on Keynesians just like Krugman. So Krugman suggests to inflate a housing bubble to make up for the dot-com bust. And of course, Alan Greenspan says, Krugman, great idea. Let's drop interest rates. Let's drop lending standards. Let's force banks to give out loans, and then let's securitize those loans into mortgage-backed sausages. And you guys know the rest. Housing prices skyrocket to an all-time high and come crashing down. But what does this do to the younger generations? Because they didn't really allow the bubble to completely deflate. It only went back to its historic trend line. Then the Fed started inflating the everything bubble to make up for the housing bubble that made up for the dot-com bubble. You see how these things work. So what ends up happening is home prices get artificially higher and higher and higher, and it prices the younger generation out of the market. Insert Moody the millennial right here with their blue hair, and it is they because I haven't found out their preferred pronouns, but they are having a great old time. Actually, no, they're not having a very good time. Moody is really bummed out, even though they have their cell phone and they are playing TikTok. I think they are bummed out because they only have a Prius worth $3,000 and a bicycle worth 75, and that was prior to the cerveza sickness, so worth a lot less now. But Moody looks at the housing market and they say, damn it, Krugman, why on earth did you suggest that we keep inflating these bubbles? Why did the Fed decide to take you up on your suggestion? Because if the Fed wouldn't have inflated the everything bubble, housing would be a lot more affordable. If I wanted to buy a house, let's say it's $100,000, I come up with $15,000 as a down payment. It might be a stretch for Moody, but if they get a couple extra jobs, maybe in the gig economy, they can save up 15 grand. Instead, the Fed and Krugman inflated the everything bubble that took housing prices up to where they are today. In some markets, even higher than 2006. So instead of Moody only needing $15,000 for a down payment, now Moody needs $30,000 for a down payment, most likely pricing them out of the market. And let's not forget, Krugman and the Fed not only priced Moody out of the housing market, they also increased Moody's risk if they want to invest in the stock market. Let's check this out. We go to a chart of PE ratios, the CAPE ratio, going back to 1880 all the way to 2020. The PE ratios go from 0 up to 40. Going back to 1880, they start off pretty darn flat, come down to a low in 1920. I'd like to make a note, right after the Spanish flu. They go straight up through the roaring 20s and peak out at the stock market crash of 1929. Stocks come all the way down. We have the Depression, World War II, But you can see it's pretty consistent throughout this whole time, usually ranging from a PE of 20 down to 5. This takes us all the way to the 1990s, where we know what happened. The dot-com bubble took stocks' PE ratios all the way up to 45, an all-time high, even higher than we had in the bubble of the late 1920s. And we get to the top of the dot-com bubble, but we know what happens then. Comes crashing down, but notice it stops right around a PE ratio of 25. The market isn't allowed to clear because Krugman and the Fed come in and want to re-inflate an asset bubble. So this takes us to 2009, where of course it comes crashing down. Finally, the market is allowed to clear to a certain degree, but then the Fed comes in late 2008 and starts quantitative easing, which takes the stock market all the way back up to all-time highs and a PE ratio higher than we had in 1929 and very close to what we saw in the dot-com bubble. And of course, the problem with this for Moody and the younger generations, that if they want to invest, let's say they've got a 401k, they want to do the prudent things, save their money, invest in the stock market, buy a home. You can see how they're already priced out of the housing market. And even if they do buy, it's a lot more risk because they have to buy at all-time highs. But even with their 401k, if they buy, they've got to buy into the no bueno zone. And what I mean by that is you can see throughout history, going back to 1880, once we get above 15 on the CAPE ratio, the stock market becomes increasingly more risky. As we go below 15 on the CAPE ratio, it becomes less risky. So what we're doing to the younger generation is we're forcing them, or we're only giving them the opportunity to invest in the stock market at times when it's the most risky. And because we're stepping in with the Fed put, we're not allowing them to buy when it's a lot less risky. Step number 3, the Fed also destroys the younger generation through the inflation tax. This works several different ways, but the bottom line is the younger generation ends up paying for all the boomers' bubbles. First and foremost, when they get into the job market, it's totally depressed because of the reasons we discussed in step number 1. The corporations aren't investing for the long term. They're not investing in creating more jobs, growing their business, because the Fed comes in, lowers interest rates, does quantitative easing, prints up all the funny money they put in the Fed put, so it incentivizes the corporations and big businesses to take that money and just buy their own shares back, invest in the financial economy as opposed to the real economy. The younger generation ends up paying for this because instead of getting out of college and finding a great job, they're left to go right into the gig economy and have 15 side hustles just to make ends meet. And while they're doing that, they're on social media, and what do they see? Of course, these financial gurus driving around in their rented Lamborghinis that are always telling them to buy the dip. Go into stocks, go into penny stocks. Whatever you do, you've got to do this because you're going to get rich and you can be driving a Lamborghini just like the one I've got parked here in my garage. Of course, we've all seen the commercials. We've all seen these guys on YouTube. So the millennials or the younger generation, because they can't get ahead by just working hard, because the economy is so fragile and because the economy has been so distorted by the Federal Reserve, they see the only way to get ahead is go into the stock market. So they set up an account with Robinhood, oil goes crashing down, and what happens? Editor, go to the article from CNBC. They pile straight into USO, the exact ETF I went over on my video the other day, and I showed it doesn't track oil at all. All it does over time is just go down. It might go up temporarily, but because they have to roll over their contracts when the oil term structure is in contango, and if you don't know what I'm talking about, we'll put a link in the description below to my video on Monday that will explain it very thoroughly. But the bottom line is USO is an ETF that is almost doomed to lose money over the long term, as long as the spot price of oil is lower than future prices of oil. So it goes right back to these young investors who watch these gurus on YouTube and come right into their Robinhood account and buy USO. The ETF saw a 300% increase in ownership month over month. Even after a pop on Thursday, the fund was down 32% this week. Thank you very much, inflation. Thank you very much, Federal Reserve. Whoa, time out. I've got to cut to a clip from my recent interview with Jeff Snyder. He really gives us some great insights as to how the Fed destroys the younger generations. How does that disproportionately affect the younger generations? Because they're just coming into the job market during this time of stress, and when these quote unquote good jobs just aren't available, and a lot of the people are just checking out of the labor market altogether. And on top of that, you have more of the retirees not retiring and competing for those jobs.
Yeah, and it hits the labor market is in some senses rigid, and it becomes even more rigid where companies aren't willing to take a risk on hiring new employees when they know what they've got who's already there.
Right.
And it becomes almost like a hiring freeze, right? Because anybody who's trying to enter the labor market, they find there's no takers for their services. And so you can understand why people of the millennial generation and the next generation coming behind them, they stay in school for 2, 3, 4 extra years. It's a form of breadline, right? It's a way to make a living without being able to work. And so they've racked up a massive amount of debt for very little return because there's nothing waiting for them behind it. It's again, Keynes had it right in the 1920s. It's the labor market which gets devastated by these monetary events, and that's what bothers me the most, because everybody says, well, the Fed created a flood of liquidity in QE. Well, no, that's not what happened. It's persistent deflationary conditions, which has kept a lid on labor market healing. And it's gotten to the point where now we're 12 years later, and now we get to experience another one. And I can't even imagine what this one's going to look like.
But that's just the tip of the iceberg when it comes to the taxes that the younger generations are going to have to pay because of what the Fed is doing. This is when they really get crushed. And what's ironic is this part of the equation is what nobody is talking about. In fact, I'm the only person, and I mean this quite literally, that I've ever heard talk about the changes to the tax code back in 2018 that's going to screw over the younger generations. Let's go right to a chart of the CPIU and the CCPIU. And this is straight from the Federal Reserve's website. This is per the Tax Cut Job Act, appropriately named, of 2018. Like Ron Paul and Peter Schiff always say, if you want to know what a government program will actually achieve in real life, just look at the name and it'll do the exact opposite when it's put into effect. And no other law, no other program is as good of an example of that as the Tax Cut Job Act of 2018. This really gets under my skin. But how this works, the chart starts at 2002, goes to 2020. The bottom number is 90, goes all the way up to 150. It starts right at 100, and the CPIU, which is the normal CPI, is represented in blue. You can see the CPIU and the CCPIU start off pretty much the same, but as time goes on, the gap between the two get bigger and bigger and bigger. So you may be asking yourself, okay, George, how does this increase the taxes that I have to pay the government? Well, it works like this. The Jobs Act, or Tax Cut Act of 2018, stated that instead of measuring inflation for the tax brackets based on the CPI, they were going to use the CCPIU. So what that does is that keeps the tax brackets lower for longer. Let's look at an example going right back to Moody the Millennial so you can see how it plays out in real life. Let's say that Moody the Millennial right now is making $20,000 a year and they are taxed at 15%. Okay? Well, let's just say that the current effective tax rate for $100,000 would be 30%. Well, if inflation goes up to the point where Moody the Millennial, instead of making $20,000, is now making $100,000, but, very important here, their wages only went up with the rate of inflation, meaning their nominal wages went up, but their real wages or purchasing power didn't go up at all. If you don't increase the tax brackets, then Moody the Millennial would end up paying a tax rate of 30%, even though they hadn't made an extra dime in real terms. So of course, they're paying a higher tax rate, but they're getting a lot less purchasing power. So as the gap grows between the CPI and the CCPIU, there's a bigger and bigger percentage of every single person's paycheck that goes straight to the IRS. It's the absolute scam of the century, and it's just another way that the Federal Reserve and the government are destroying the younger generations. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.